Hello everybody, thanks for joining me this for lesson of getting started in technical analysis. This lesson has been split in different parts because I want to keep it as short because it is a very important concept, and then no more than 5-10 minutes, so in that way you can get confident with those information. We are gonna talk we will be talking about trends, trend lines, supports and resistances. In this first part, just definition of trend and support and resistances. Let's get into it, and hopefully you're going to enjoy the video, and my video will disappear just to give space to the presentation. So let's get into it. So what is a trend? Trend is just the direction of the market. Trend defines the price direction. The price direction, the price does not move in straight lines, but it moves in successive waves or zigzags, forming toes and peaks. So now, if those series of successively higher is peaks and toes moves upward, so it's the next, it means that the next peaks is higher than the previous one, and the next toes is higher than the previous one. We say that we have an upward market. While if on the opposite side, vice versa, we can say that you have a downward trend. Now, those are the main two. There are three trends actually. Those are, we would like that the market is always downward and upward, but unlikely there is even the trendless or the sideways trend. The sideways trend is when the market moves horizontally. In that situation, what we can say that we should stand aside. Stand aside means that we just need to look at the market without investing. And without investing, we should wait. Or the maximum that we can do, we can see later. We can do some short investment and get some money. But the best idea, the best option is just to stand aside, to not invest in those markets. While all the majority of those technical analysis tools, like Trendline, is a tools of technical analysis, they work mainly for trends, for upward and downward trends. When the market has a trend, we can apply all those amazing technical analysis tools. Otherwise they don't work properly. Quick update on what we say. We can say up, we can call upward, we can call bullish, we can call uptrend, and we can say when we buy stocks, or perhaps we can buy oil or commodity, we say we go long. When we sell in a market that generally is bearish, we say we go short. In fact, the downtrend or downward or bearish means the same. We can use in the same way. So it's a market that is bearish, is going down, Bullish is a market that goes up. Trendless is a market that just goes horizontally. There is no trend. The word means says everything. When we go long, generally we buy. What does it mean? It means that we are buying from someone that is selling, because there's always someone selling and buy. So generally, when the market is bullish, we want to buy, because we want to get profits from this market that is going up. So if the market is growing, we would like to buy in this market. But when the market is falling, is going down, we don't want to buy, because it's falling down, but we want to sell. So we say we will sell, or we go short. We sell because what we sell, we don't sell anything, but there will be someone that it's ready to buy, so we need to sell to allow someone else to buy. That's all. It's very easy concept. So go long, we buy. Go short, we sell. For a bearish market, while for a bullish, we go long and we buy. This is the main concept. Again, as Dow's theory, we have the trend has been classified in three different trends. We have near-term trend, immediate trend, and major trend. Major trend is going to last over 6 months, not over years as Dow's. The intermediate trend is the same as per Dow, 3 weeks to 3 months, and the near-term trend is less than 2 or 3 weeks. You can see from this chart, this is a gold. We can go in detail later. For next lessons, just this is a downtrend. This is we can be defined as major trend is uptrend, but we are waiting the third point to form this one to define that it is an uptrend. We'll see it later in the next slide, next lesson. This is a sideways trend, and the blue line is near trend, is a short term, and the intermediate trend is just the green line. So this is basic concept. Generally, all the technical analysis tools have been developed for intermediate trend that is between 3 weeks and 3 months, but we apply the same. Those concepts can be applied for the major trend and near-term trends with some considerations, but generally those pattern or those technical analysis tools has to work for all different timing frames that we will see later. There are different timing frames important for us. So let's move on. And let's move on to the concept of support and resistances. Supports and resistances. Supports can be defined just the thoughts of a trend, while resistance can be seen as the peak of a trend. And again, the support, we can read the definition properly, but the support is where more people are buying rather than selling, and while the resistance is exactly the opposite. There is more people that are selling and less people that are buying. This is the main concept. Why those are important? Because a higher successively supports and resistance give us an uptrend, while a lower successively low trend and low supports and low resistances, they give a downtrend. So this is the concept of uptrend and downtrend. Just if you want more information, just read it. It's explained even better than what I'm telling you. Then let's move forward, and this one is the idea. This is important because generally the trends, when we have a trend, it's much easier for the trend to keep moving forward, upward or downward rather than turning. But when perhaps there are situations where we are expecting that the point C should exceed the previous peak, or perhaps in a downward trend, in a bearish market, we are expecting that the point D is going to be lower than the point B, but it's not happening, or it has not happened. This one gives us a warning. So for us trader, this is a warning. Perhaps the meaning of this one can be that the market is reversing. So in fact, they are calling as reversal pattern. Just memorize those reversal pattern, because when you will be doing the study of the prices for a given chart, you will need all those to remember all those information. And some other important information from that the resistance can become a support, and the support can become a resistance, as I showed in this example. Why for all the trends, for uptrend, downtrend, and for sideless trend. Why this is important for us? Just because when we need to have some target price, it's important for us to know those information. But this happen only when there is a penetration by a significant margin. What does it mean? A significant margin can be 1 or 3%, depending for a major trend or for a short term trend. Generally, for a major trend, it's gonna be a 3% penetration, while for a minor trend, it's gonna be 1% penetration. What does means 1% or 3%? I give you a very nice example for an sideways trend, so for a trendless, where the resistance 1 became support 2 and forming a new resistance 3. But this is the concept where a breakout point, we need that this breakout is going to be at least one. This is a short term, at least 1%. So it means that this price needs to be increased at least 1%. So 2 say, or 3%, perhaps if we want to be more confident, we would like to reduce the risk. We say if it's gonna reach 3% more of this price, we are happy that we are more confident. With technology, we are never sure. We are not 100% sure. It's just being more confident. We are just more confident that it can really be a breakout point, and the market can keep going up. In this case, we got the resistance was found at almost 9.7%. But this is just to give you an idea how to calculate the percentage of penetration. So we need to find the price that is gonna give 3% penetration. We just need to reverse this equation, and it's nothing complicated. But if you want to know more information, just let me know, and I will provide more information. We don't need just to find it. Just when we see the level there, we just apply these calcs, and we can find the percentage. I hope everything is clear. If not, just please let me know. We can discuss more in the comments. Again, another important concept is the round numbers. Round numbers, they work as supports and resistance sometimes, not always, but round numbers, they work as supports and resistance. It's important to know that there will be some specific numbers like 10, 20, 25, 100 or thousands, multiple of thousands, that where the market is going to stop. Why? What is the reason? It's mainly based on us, on our behavior. It's more psychological supports. It's a more psychological psychological support. This is important because we can use this information to buy and to sell. So or to find our price target, our objective, and we can set some stops and some orders. But when we set those stop and orders, please never do it at the rounded number, but a little bit lower or a little bit higher, because sometimes people start selling. People, our traders, they saw that it's getting close to the number 35, they start selling before getting the rounded number. So perhaps this rounded number will be never reached. So it's better to just keep on the safe side and reduce a little bit our target price stop and or our buy order. The same applies to this point P. Those are the end. This is the end. Just please bear in mind those information. Those are just tips and the main information that you have discussed during this presentation. Thank you very much, and I will see you to the next presentation. Bye.